Hey everybody, welcome back to the channel. So portfolio is up to $25,750. RSP is up 10% all time, and the TFSA is up 3% all time. So the big news with my portfolio this week is that Aritzia released some earnings and investors were not happy and the stock dropped immensely. So I'll be going over what I'm going to do with them. Microsoft looks like they're going to be buying Activision Blizzard. After all, it's pretty much a done deal, so we'll be talking about that and the implications of that. So after Aritzia released their earnings, the stock went down about 24% in a single day. I took the opportunity to purchase 3 more shares, going up to 40 shares overall. I did listen to the earnings call, and I'll share some of the things that I heard there that made me confident enough to continue averaging down in the company. And let's look at those earnings. So the key highlights from the earnings report are that net revenue increased 13.4%. So their top line actually did increase. And you have to keep in mind that in the previous 2 years, they have grown at a tremendous rate. So the fact that they call this a very difficult quarter for the company, and the fact that they still are growing that top line is a positive, probably one of the most positive things on this earnings report. The United States revenue also increased 21.8%, which is pretty great, and it's now comprising about 54% of the company's total revenues. The United States is really where this company is focusing on growth. It's a much larger market, and if they can succeed in the United States, this company can really increase in value by several times. The retail net revenue increased 13.8%, and the e-commerce also increased by 12.5%. Now, where people are not liking the earnings report is, one, there is deceleration in the revenue growth and the net revenues, and even the e-commerce net revenues. But they are citing that there's a lot of inflationary pressure and that the consumer is being strongly affected, and that these are macroeconomic reasons. So reasons outside the company are causing this lack of growth, you can call it, even though I think 13% of the top line is actually quite good and still solid growth numbers in the States and even online. Now, the gross profit margin is decreasing. Of course, they have a lot of inflationary pressures. Materials are costing a lot more, and they're not passing that cost on to the customer just yet. But they did announce on the earnings call that they were going to increase the pricing of certain pieces going forward. So that should help with their profit margins, which are being pressured right now due to the increased costs of the materials, and also the fact that they have to pay extra warehousing costs to store their excess inventory, which they really stocked up on during the pandemic due to the fear of the supply chain and the uncertainty around that. But that should normalize over time as they are selling through their inventory. And they also are building a distribution center in Toronto, which will service Eastern Canada as well as the United States. So that should get rid of those temporary warehousing costs. It should improve their logistics and their overall bottom line. So that's going to be done in August. So that's another positive in the company. And they do believe that even though the gross profit margin is going to decrease in future earnings this year slightly, they do see that the gross profit margin is going to increase going forward longer term, probably into the next year. The net income, is really showing here is down 47.5%. Keep in mind, though, that they are opening new stores and they have to put money down for that. So I don't mind them investing in themselves to grow a distribution center to help, give the supply chain and logistics that they need to continue growing the company. So it really just sounded like they are investing a lot this year to help feed further growth in the future. So they did say that, they're growing the square footage of their stores by 15% this year, and that they foresee a lot of rapid acceleration in 2025 of about 20% increased growth in square footage. So overall, I mean, people are freaking out about the net income and the profitability of the company, but from what they were saying, with the improvements that they're going to have and the lowered expenses, once these temporary expenses come off the books, they're going to make a lot more profit. So we'll keep an eye on Aritzia, but overall, I'm pretty happy with the company. They're still growing their net revenue despite having really, really tough comparables to the previous year. And I don't see the fundamentals of the business getting worse. This just seems like, investors are looking at, what's the profit now? I don't care about a year from now. I don't care about 2 years from now. I care about this quarter, which is very short-sighted, and that's not a way to invest. I even, saw some comments online about, Aritzia fell 25%. I guess I should sell my shares. And you really can't allow the stock price movement or volatility to affect how you feel about a business. That's not the way to invest, using emotion and following the crowd. That is actually the opposite of what you should be doing. I'm paying attention to the fundamentals of Aritzia. I see net revenue growth. I see United States sales growing. I see e-commerce growing. And, if this is a slower period, that's fine as long as they're continuing to grow, opening more stores. I just don't see how this company doesn't continue growing. I also purchased one more share of ETHY, going up to 72 shares. And how I fund that is by shaking my phone with Shakepay every single day and getting free Bitcoin. So feel free to use my link in the description below to sign up for that. And if you want to start investing with WealthSimple, you can sign up using my link. You help support the channel. And if you make a deposit, you can get up to the value of $3,000. And I also purchased 2 more shares of Granite REIT because it took a nice little dip. So we're up a little over 9 shares of this company now, which is great. So I started this position, not too long ago, and it's coming along nicely. I really, really hope that the price of this falls even more so I can continue adding to it regularly and averaging down. HYLD is up to 208 shares. So I just repurchased 2 more shares with the dividend that I received from HYLD. So that's basically what I'm doing every single month until this breaks even or even goes higher than my cost basis. Then maybe I'll look into taking those dividends and investing it in the best opportunity at the time. And with Microsoft, which is up 25% for me. So again, big tech this year has been absolutely crushing it. That's why it's good to be diversified into different sectors, because you never know which one is going to be the best of any given year. You won't know why, and it's just going to happen. I thought big tech would recover, but not to the extent that it has. I just thought it would go up to its fair value, but I think a lot of these technology companies are actually getting a little bit greedy and a little bit euphoric, so do watch yourself out there. But the big news with Microsoft is the fact that they won their case against the FTC. So Microsoft has basically won the court battle against the FTC, and the FTC is trying to appeal it, but it does look like their case was very, very weak to try to block the merger. So one line I just want to point out here that the judge pointed out is very interesting. So on just about every point, the judge found the FTC's arguments wanting. In particular, she was unmoved by Harvard economics professor Robin Lee's analysis that Microsoft would have a financial incentive to make Call of Duty and Xbox console exclusive, and wrote that it failed to take into account plans for the franchise to remain on PC, come to the Nintendo Switch, would be a brand new console, it would make the game more accessible, and become accessible through cloud gaming. So before the merger, a consumer wanting to play a Call of Duty console game had to buy a PlayStation or an Xbox, Judge Corley wrote. After the merger, consumers can utilize the cloud to play on the device of choice, including it is intended on the Nintendo Switch. Perhaps bad for Sony, but good for Call of Duty gamers and future gamers. So the big argument against Microsoft trying to buy Activision Blizzard is that they would become some sort of unfair monopoly. But I really love that the judge pointed out how Sony would be the biggest loser here with Microsoft actually going ahead with the deal and putting, some titles onto the Nintendo Switch and making games more accessible on more platforms and not forcing you to buy a console. Sony has been locking people into buying a PlayStation because they have a lot of exclusives, and they're trying everything in their power to paint Microsoft as this big unstoppable force, when in reality they're the monopoly that is doing what they're accusing Microsoft of is that that they want to take these games away and make them exclusive on Xbox, but that's not what they're doing. So I think overall the judge acted very rationally, listened to the points. They knew that the case was very, very weak to block the acquisition. Even with Microsoft owning Call of Duty, games like Diablo, which I can't stop playing. Let me know in the comments below if you're playing Diablo and what class you're playing. And, there are other mobile games like Candy Crush, which Microsoft has been wanting to get into mobile gaming, but, this is a great avenue to get into that. It's very synergistic to the business, and it should help their gaming division in the future by having, some higher quality intellectual property in the gaming space, because really they don't have much. I mean, they have Halo, which is a very old franchise. They have Gears of War. I don't know if anybody even cares about that anymore. So getting Call of Duty, which is just a money printing machine, should be great for Microsoft. And when this was announced, Activision Blizzard stock actually went up a lot. So if you were playing the arbitrage play, good for you. You did very, very well. And with Smart Centers, I purchased one more share, going up to 60 shares. So, just increasing our real estate while it's down, and it's a great time to average in. So we're going to keep getting more of that monthly cash flow, which I really like. And then with TELUS, I purchased 4 more shares, going up to 69 shares. And one of the shares, I pretty much just used my TELUS dividend. It nearly bought me a full share. So I'm going to continue my plan of buying 4 shares of TELUS each and every month. And it's already at the point where my dividend can purchase the share, but that's mostly due to the stock price just declining this year. So I'm going to continue doing that until the end of the year, and I'm pretty happy with the company overall. So it's great to be able to average down. I'm very happy to continue buying shares of my companies while they're beaten down and not receiving the love and affection that they deserve. So if you enjoyed the video and you want to keep up with my updates, as I buy new stocks, sell stocks, or there's any kind of news surrounding my portfolio, as I'm trying to build a stream of passive income to eventually, pay off some bills and then eventually completely pay my expenses, please do like and subscribe to the channel so you never miss an update. So the dividends earned all time are up to 15, 60, and 10 cents. Annually, I've crossed over $1,100 per year in dividend income, which is nice from the previous 1083. The monthly average has also increased from 90.26 to 91.77. And the big milestone that I achieved, which is one of my goals for the year for 2023, was to earn $3 a day in dividends. I've finally crossed that, so we're up to $3.02 every single day from dividends. And the next goal I have is to earn $4 a day in dividends. So you may notice a pattern that I just continually have set goals. Once I achieve them, we make new goals to stay motivated and just continue growing this stream of passive income until it can actually, make a meaningful impact in my life and my ultimate goal of financial freedom. And the hourly wage for my portfolio, if it were to work a 40-hour work week for me, it also got a raise at its job. So 53 cents per hour versus 52. And my other goals for the year were to get $1,000 a year from dividends annually. I crossed that, so I made a new goal of hitting $1,500 per year in dividends. And now only one goal remains for 2023, and that is to earn $100 per month in dividends. So I just need to increase my passive income by about $8 a month over the next 4 months. And I think that's very achievable. So I'm definitely going to be looking forward to doing that. And thank you so much for watching. If you've stuck around, let me know in the comments below what you're buying, and have a great day, everybody.